And share the screen. So what's new with Social Security? Hopefully everybody can see my screen. Perfect. All right, so for those who may not be familiar with who I am, my name is Marcus Rather. I'm a financial advisor here, office located in Glen Allen, Virginia. I'm a representative through Cetera Investors, and I specialize in holistic financial planning, not only creating financial plans for my clients who are looking to accomplish their goals leading towards retirement, but their goals are also important to protect the wealth and retain the wealth within their family. Making an easy transition to the next generation or the next organization that's important to them. So not only retaining that wealth within the family, but also encouraging the intangible aspects of financial planning, things that attribute to your legacy, your values, and making sure that story is continued to be passed on for future generations. So all my contact information is there at the front of the screen. I will be reaching out to everyone in attendance today for any feedback or follow-up that you have from this experience. So 7 key agenda items that we'll be addressing today around what's new with Social Security. I will preemptively say that bullet points 4 and 5, I would somewhat fly through. I'm going to go through the Medicare premiums and I'm going to go over the Medicare dates to watch. I will say, one, you're probably going to have a lot of questions about what you hear today with Medicare. So I would just parenthetically quote, you do want to mark your calendars or keep in mind that we will be doing a Medicare webinar in May. So please keep in mind, be on the lookout for any emails or communication for future webinars in May around Medicare. But we will be going over some brief information today. And these are the 7 items that we'll go through. So starting off with cost of living adjustments, the good old COLA, C-O-L-A. So for those who may currently be drawing their benefit, or if you're still in the process of waiting and delaying your benefit, you may have heard an announcement that there's an adjustment or addition to that benefit. And that adjustment is a cost of living adjustment. So every October, and every year, every October, Social Security Administration, they announce a bunch of numbers that are determined for that rate of inflation. So they look at the prior 12 months leading up to that announcement, and they determine what percent will be added to the benefits. So in addition to the monthly checks that people are receiving for Social Security, cost of living adjustments will also be impacted on new earnings test thresholds, as well as higher Social Security wage base. So we're going to go over those other 2 in a few minutes. Looking at the monthly benefit for someone currently getting a benefit, if they were getting $1,000 per month with the most recent cost of living adjustment, which was 3.2%, they would have seen an additional $32 in their monthly check. So previously they would have been getting $1,000. Their new benefit after the cost of living adjustment is $1,032 in this example. Something interesting to point out is that 3.2% is the same for every person receiving a benefit, or 3.2% is the same for everyone delaying their benefit as well. But you see that 3.2% looks different depending on the number. And why we highlight that is as we talk about conversations on, when's the best time to draw your benefit, if we're looking to maximize your benefit, if you're considering delaying, that 3.2% seems minimal on 1,000, but it seems substantial on a larger number. So keep in mind, cost of living adjustments, while they aren't guaranteed every year, because there have been some years where there were not any cost of living adjustments added, it is possible that you can have them, and you do absolutely want to maximize your benefit by possibly delaying drawing Social Security or just being familiar with having a larger amount plus the cost of living adjustment. So to put that into perspective, as I previously just said, last year, or the declaration for 2024 was 3.2, and even in 2023 was 8.7. But if we go back from 1989, where that was 4%, from 1989 until most recently, if we take an average of every year of cost of living adjustments, that average was 2.6. But you can make note that in years like 2010, 2011, and even 2016, those were years in which there were no cost of living adjustments added. So from a planning perspective, we like to look at the average, but please be aware that every year you may not be awarded a cost of living adjustment. It's all predicated on what inflation looks like in the 12 months prior leading up to October for when they actually make that declaration. So that's the cost of living adjustments in perspective. Again, look at it from a historic perspective. So how it's calculated, what they do is they take the CPI. That's going to be a definition that I'll go over in just a second. A lot of definitions that we're going to go over through our experience today. But the CPI is a consumer price index. What that is a measurement of the change in a basket of goods and service that a typical urban worker might buy. Now, I don't know who the typical urban worker is. That Social Security Administration determines who that is. But they essentially take a look at a basket of goods and services, and they take a look at the increase in those prices, whether it's food, transportation, housing, entertainment, healthcare, or anything else that average person may be spending money on. In any case, the cost of living adjustment, again, is announced each year in October. So whatever has happened from October of last year leading up to about September of this year will impact the declaration of the cost of living adjustment for, in this case, 2025. So whatever the cost of living adjustment is or what's declared, it takes in effect January of the following year. So just how the declaration was made in October for 3.2%, most people drawing their benefit saw that increase effective January. Now, the second thing that cost of living adjustments impact are earnings tests. So earnings tests are more applicable for someone who is currently drawing that retirement benefit, but may have started to elect that benefit prior to their full retirement age. So this presentation, we don't go over everyone's full retirement age, but chances are if you were born somewhere in the 50s, if you're not yet 65, your full retirement age is either 66 in some range of months, whether that's 6 months, 8 months, or 10 months, or if you were born 1960 or later, your full retirement age is 67. That's the age at which you can get 100% of your benefit from Social Security. Now, your earliest eligibility is age 62. So if you happen to take it at 62 or any age leading up to your full retirement age, you are taking a reduced benefit. But if you're choosing to continue to work, if you're still working and receiving any type of wage, salary, tips, or earnings, there's a limitation on how much earnings you can have before that impacts your Social Security benefit. So that number for 2024 is now $22,230. As you can see, that is an increase from last year's earnings limitation of $21,240. In the first year of which you're drawing your benefit, there's actually a monthly limitation. We'll go over that in the next slide. But from an annual perspective, if your earnings exceed $22,320, there will be an impact. As you can see in the third bullet point, for every $2 in excess of that amount, they withhold $1 of your benefit. So if you're receiving benefits and you turn your full retirement age, so say someone started taking it at 65, and in this year they will be turning their full retirement age. Well, in the year of which you turn your full retirement age, that threshold is actually higher. So you can see in the year you turn your full retirement age, that income number is $59,520. At that point, every $3 in excess of that amount, they would withhold $1 of your benefit. After you reach your full retirement age, there is no longer any earnings limitation. So by the time you reach your full retirement age, therefore after, you can earn whatever amount and it will not impact your Social Security benefit. Now, please keep in mind, even though it is a withholding of which they reduced your benefit at that time, you do eventually get that money added back towards your monthly benefit after you reach your full retirement age. But then it raises the question, was it most useful for you to draw your benefit and continue to work if you're going to have that income benefit reduced? To the monthly earnings test, in your first year, say someone decides to take their benefit in July or August, where you wouldn't see a full calendar year, you would theoretically have a monthly earnings limitation. So if your monthly earnings exceed 1,860, which times 12 would equal towards the annual earnings limitation. But if you file for your Social Security in 2024 and you're currently under your full retirement age and you continue to work, your benefit will be withheld for the $2 in excess of the $1,860 per month. The following year, you'll be subject to the regular annual earnings test, which that number was at 22,000 that we saw in the previous slide. Payroll taxes. So the third thing of which cost of living adjustments have an impact on is the payroll taxes that are paid into Social Security. So for 2024, the annual earnings that are subject to Social Security taxes. So this is for anyone who is still working or receiving any wages, salaries, tips, etc. Your first 168,000 in earnings, or 168,600, are subject to Social Security taxes. Previously, 2023, that dollar amount was 160,200. So cost of living adjustments have not only increased monthly benefits, but it's also adjusted the earnings limitation for those who are getting a benefit and still working before their full retirement age. But it's also impacted the total dollar amount of someone's earnings that will be taxed and paid into Social Security. So for higher earners, they're going to pay Social Security taxes on more of their earnings. Remember, Social Security taxes represent a pretty good investment in the form of inflation-adjusted income that lasts for life. The more earnings you have and the more Social Security taxes you pay, the higher your benefit will be. So as long as you're working and paying into Social Security, your benefit will continue to be adjusted. If you improve your earnings record, your benefit may go up even if you've already started collecting. So as an example, someone decides to start drawing their benefit at their full retirement age. Well, if they're still working at full employment, Social Security still takes an average of your highest 30 years of work history. So if you continue to work while also drawing your Social Security, that could be a way of also increasing your benefit while claiming. Not always a suggested thing, but it is a good thing to know. So payroll tax, right? So the tax rate remains 6.2%. In total, it's 12.4%. If you're someone that's working for an employer, on your W-2 or on your pay stub, you can see the amount that you have withheld for OA SDI. That would be old age survivor disability, right? You, as an employee, will pay 6.2% up until the 168,600 are earned, and your employer will pay the other 6.2%. But for all of my entrepreneurs, self-employed individuals, who are the employee and the employer, you're paying the full 12.4% tax towards Social Security. And there was also no change to the Medicare tax as well. So for someone who is an employee, 1.45% of your earnings are paid into Medicare, and the employer pays the other difference. Again, for all self-employed individuals, that percent in total is 2.9%. So self-employed or business owners are paying both portions as the employee and the employer. So to put that into perspective, if your top earnings are 168,600, you multiply that by the 6.2%, and that means $10,453 of your earnings were taxed into Social Security, just as the employee. If you double that number, that's the employee and the employer. That's 12.4%. Now we're going to switch, since we're talking about taxes paid into Social Security, we're going to switch to taxes on Social Security benefits. This is your first time hearing this. Please understand, Social Security benefits can be taxed on a federal and in some cases a state level. The state will depend on which state you reside. I believe, I'll say consult with your tax professional on all the tax specifics of Social Security or any tax recommendations. What I will say, to my knowledge, I believe Virginia is a state that does not have taxes on Social Security benefits, but also other states that have no state income taxes, like your Texas, like Florida, they also are examples of states that do not tax Social Security. Today, we're going to be focusing on a federal perspective, your federal taxes. As you can see, we said cost of living adjustments that had an impact on current benefits. Cost of living adjustments had impact on the earnings limitation. Cost of living adjustments also had an impact on the percentage or the dollar amount that are taxed into it. Well, what you'll see is that cost of living adjustments were not impacted on how they treat or how they calculate the taxation of Social Security benefits. So I remember we did a webinar or a seminar last month. A few people had questions on how do they fully determine it. This is going to be exactly how you know. So that star that you see on the screen, provisional income is essentially your adjusted gross income plus half of your Social Security earnings. So again, provisional income is calculated using your adjusted gross income plus 1/2 of the Social Security benefit, plus any tax-exempt interest. For those that may have recently filed your taxes, you can find your adjusted gross income number on line 11 on your 1040. Whether you are looking at this most recent one or the last year's 1040, your adjusted gross income can be found on that line. But if you were to calculate that adjusted gross income plus half of your Social Security benefit plus any taxes and interest, for those who are married filing jointly, for your Social Security to have a 0% amount subject to taxes, that total amount would have to be under $32,000. If that amount exceeds $44,000, again, married filing jointly, if that total provisional income exceeds $44,000, up to 85% of your Social Security benefit will be subject to federal taxes. So the good news is 15% you get tax-free for Social Security, so that's a fun thing. But depending on your total provisional income, up to 85% of your benefit can be taxed on the federal level. For those who are single or head of household or qualifying widower, married filing separately and living apart from the spouse. I really got to emphasize that because I know many couples who are married filing separately but live together. Your threshold is a little bit lower. So as long as your total provisional income is less than $25,000 a year, Social Security won't be taxed on the federal level. But if it exceeds $34,000, up to 85% can be taxed on the federal level. And you can see married filing separately, but you're still living with the same spouse, whatever dollar amounts that you earn, up to 85% of your Social Security benefit would be subject to federal taxes. So bigger point here is that cost of living adjustments, we saw what they have impacted over time and over history, but the taxation of Social Security benefits have not seen much of a cost of living adjustment since the origination. So required minimum distributions. Why are we talking about required minimum distributions in IRAs when we're focusing on Social Security? Well, for one, there have been a few laws that have passed dating back to 2019 up until most recently, of which they've extended the required minimum distribution age. So it used to be 70 and a half. And for anyone who was 70 and a half prior to that law change, their required minimum distribution age began at 70 and a half. But they extended it to 72 a few years ago. And most recently, with the passing of Secure Act 2.0, that has now extended to 73. So for anyone who has pre-tax qualified retirement money, whether it's 401k, IRA, 403b, TSP, if those monies have not been taxed, if you are not yet 73, you can delay drawing that money up until you turn that age. So the required minimum distribution is age 73. And for those that were born after 1960, that age is actually 75. So there are two different ages to remember, depending on the year in which you were born. The new IRS life expectancy table allows you to take a bit less when you first start taking distributions. But the reason we're bringing this up, as we were talking about taxation on Social Security, is remember, distributions from retirement accounts can be taxable. And if it's taxable, that adds to your adjusted gross income, which adjusted gross income adds to that provisional income that we saw in the previous slide. So you want to be familiar with projected required minimum distributions, whether you're 10 years away, 3 years away, or within the next year. You do want to be familiar with, what impact required minimum distributions will have on your total tax picture, because there are some savvy ways of, minimizing the taxes on distributions from your retirement account. So ways to try to minimize your Social Security benefit. One, is if you have yet to draw your Social Security, maybe a part of your spend down plan or your income plan in retirement could be to draw down the extra money that you have saved. I know it's a very far-fetched idea. I've had plenty of conversations of which, I'll be honest, I haven't won those conversations. But there's the theory with tip number one is that you spend down the extra savings that you have. The advantage there is that one, you're spending down the money to minimize RMDs in the future. Number two, you are minimizing the tax treatment on Social Security because you're not earning it yet. That money won't be subject to tax as early. But the larger benefit is if you're spending money from other sources, you're giving Social Security time to grow. For every year that you wait past your full age, you may be familiar that there's an additional benefit of delaying drawing your Social Security. So in addition to the cost of living adjustments that we saw that are generally announced every year, they also give you an additional 8% for 1 full year of delaying drawing your Social Security. Tip number two could be possibly converting some of those pre-tax money into Roth or after-tax assets for retirement. With converting it, you are paying it in the current tax year, but moving it to a Roth IRA then allows that money to grow to potentially be passed on to the next generation or to just simply be used at a later time in your retirement. But that's theoretically a bucket that you're not required to withdraw, and you just have complete control over deciding when and how you would like to withdraw that money. Tip number three is simply just delaying Social Security. Again, reducing the number of years your income is subject to tax. While I will say that's typically not the biggest reason of delaying Social Security for taxes, it is an idea, but in most cases, that's not the sole reason to delay drawing Social Security. Getting to tip number four, 2024 Medicare Premiums. So with the cost of living adjustment that, again, impacted monthly benefits, that impacted the earnings limitation, that impact the dollar threshold for taxes, we also saw an increase in Medicare premiums. So Part B, for those that are enrolling in Part B, or those that are part of Medicare now, their Medicare premiums likely are $174.70 per month. The reason I said likely is because depending on the total earnings in a household or the sources of assets, some people may have to pay more due to an income-related adjustment towards their Medicare premium. So there was also an increase in Medicare premiums that are paid on every month. There is a hold harmless provision. I would encourage you to, I'll say Google this. I would love to be the source, but again, I'm trying to limit how much Medicare talk we have today just to not ruin anything for May. But there's a hold harmless provision in which it applies when Social Security cost of living adjustment does not cover the increase in Part B premium. It's not as simple by percentage, but it's more specific in dollars. So if the dollar amount of Social Security is not greater, or if that increase is not greater than the increase in Medicare premium, they make sure that your Social Security benefit will not be reduced as a result of that. So it didn't apply to your Social Security cost of living adjustment, as you saw, with 3.2%. So they saw that 3.2% pay raise in their benefit, but the Medicare premium increased by 5.9%. When we look at cost of living adjustments versus cost of premiums, Medicare premiums on average have been higher than the cost of living adjustments added towards your benefit. The income-related monthly adjustment amount for those that are, higher earners in retirement or subject to extra taxation because they're withdrawing money from retirement assets based on R&Ds. The additional Medicare premium, if modified adjusted gross income exceeds $103,000 if you're single, or if you're married filing separately, or married filing jointly, $206,000 if you're married filing jointly, then you may have a income-related adjustment towards your Medicare premium, in which you would pay an extra dollar amount per month just on your Medicare Part B and Part D prescriptions. The premium is based on modified adjusted gross income reported 2 years prior. So it's retroactive would be the better word to say. So your 2024 premium will be based on your 2022 tax return. Where we've seen issues like this happen, even if it's a one-off, if there was a major distribution from retirement assets, or if you had extra bonuses that may have been paid out prior or leading to retirement, they look back 2 years. So earnings that you made 2 years ago could possibly impact your premium on your Medicare Parts B and D. As a chart, again, I'm not going to spend too much time on this today because we do have a Savvy Medicare Planning seminar scheduled for May. But if you take a quick glance, again, depending on your filing status, whether you're single or if you're married, filing separately, or if you're married, filing jointly, there's a certain income threshold in which you have to exceed for that Medicare Part B premium to be higher than the base of $174.70. A few dates to keep in mind, a few dates to watch. January 1st through March 31st, the Medicare Advantage disenrollment period, in which you can switch from a Medicare Advantage plan to an original Medicare plan. The Medicare General Enrollment period, if missed initial or special enrollment period, can enroll in Medicare now. Coverage will start the month after enrollment. So this is more specific to Medicare Advantage. For open enrollment for Medicare, October 15th to December 7th, that's the open enrollment period for Medicare. That is when, or if you happen to exceed or miss the opening deadline for turning age 65. If you have original Medicare, you can switch drug plans effective January 1st, 2025. If you have Medicare Advantage, you can switch plans effective January 1st, 2025. And the plans change, so you do want to compare the current plan with any other available in your area. Again, may have some questions there. I'll just simply say, reach out to me for any specific questions around Medicare, or be on the lookout for the Medicare May webinar. Now, point 6, the future of Social Security. I love talking about this because oftentimes what I hear as to why people should take their benefit early, 1, might not live long enough to see it. 2, it won't be there when I need it. So when people are expressing that, oftentimes they're speaking towards the trust fund, which most are not familiar with, but this is what they're speaking to unbeknownst to them. So as we saw earlier, right, there's a certain dollar amount of earnings that each person who's participating in Social Security, which is a fun fact, each person participating in Social Security are paying dollars into. So there's a revenue stream of what's being paid into Social Security. Same way that you have a revenue stream going in, you have expenses coming out. Again, old age, survivor, disability, whatever the case may be. So there's expenses that are being paid out. Through, I believe this is referencing the baby boomer generation, but there were, at one point, there were extra dollars that were being paid into that built a reserve. No different than someone setting money aside and saving it for their retirement. There's a reserve for Social Security. Now, these numbers are a bit outdated. As you can see, the trust fund balance from December of 2021 to December of 2022. Currently, we are in March of 2024. So those numbers have not been updated yet. You can still see that in 2022 and in 2023, there was a deficit. So there was a decrease in the trust fund reserves to meet those obligations. So current projection is that that trust fund reserve, if no type of change or if no reform were to be enacted or implemented, the reserves are what are set or projected to be depleted. At which point, if that does happen, there will be a shortfall of about 30%. As you can see in 2034, basic revenue of what's being paid into Social Security is projected to meet 80% of obligations. And by 2097, that number would be 74%. And again, that's without any reform whatsoever. So there's still going to be some benefit from Social Security. If you want to plan for the worst would be preparing for a pay cut of 25 to 30% in retirement, again, assuming no reform. But what would it take to restore solvency? Simple math, simple accounting. One option could simply be increasing the maximum earnings As you saw, the maximum earnings is currently 168,600. When we look at the percentage of people who earn more than that amount, there's a large number of people who make more than just 168,000 a year. So more money being paid into the system can help with the solvency, additional, which no one wants to do, but they could also increase the percentage of taxes that are paid into it, but that is also an option. You can also raise the normal retirement age. Might not impact those who are very close to Social Security, but for those who are far away, i.e. me, they could extend the age of Social Security at full retirement age from 67 to something like 70 or 69. They could also lower benefits for future retirees. Again, not likely to impact those who are very close to claiming their benefit, but those who are 40 years away from claiming their benefit, that may be impacted for them. Or they could reduce the cost of living adjustments. As you saw, historically it's been 2.6%. They could adjust the rate at which cost of living adjustments are declared. So instead of having years where it was 8.7 or 5.6, or even 4 or 5% like years past, they could adjust that percentage to have a better projection over the longevity. So will they address it this year? I don't have that crystal ball. We have no idea. This is an election year, so I can't imagine if we will see anything this year in terms of reform around Social Security. But there is one specific act, the Social Security 2100 Act, introduced by John Larson of Connecticut. It may come to a vote this year that would restore its full solvency without affecting benefit for current retirees. But the chances are, because the trust fund reserves do have a fair amount of years of lasting, we may not see any type of major reform this year. So continue to be in prayer and pay attention to your local elections. Last bullet point, claiming strategy. So a few updates here. I'll say these aren't new. This is actually something that unfortunately has been going for quite some time. But back when I started in the industry, 2016, that was the same year that they did away with a strategy called file and suspend. I sincerely apologize. Don't associate that with me. I had no claim on that one. But it used to be an option or a strategy for people to file and suspend. So in this strategy, the higher earner would file for their benefit, but suspend taking that monthly benefit, then allowing the spouse or whoever the lower earner was at that time to claim a spousal benefit off of their record. So that was as good as gone as of April 2016. But for those who may currently be 70 and have exercised that, this is that year at which you likely will be switching to the maximum benefit. Also, a strategy that was unfortunately taken away as of November 2015, there's a strategy called claim now, claim more later. So it used to be possible to claim a spousal benefit while your own benefit was building delayed credits, but they also abolished that strategy in November 2015. So for someone that likely took a part in that strategy, they're currently again turning 70. So everyone is grandfathered now. So for those who have not, or were not of age to exercise that strategy, there are still a few claiming options that you do have, more so towards lower earners, spouses, survivors, or those who have reached who are divorced and have been married for greater than 10 years. So lower earning spouses can receive 50% of the higher earning spouse's primary insurance amount, the PIA. For those that aren't familiar with PIA, that is just the full benefit amount at your full retirement age. That's what they call the PIA. If the spouse, if their own record exceeds 50% of the higher benefit, chances are they won't be able to take that spousal benefit or that spousal supplement. Also understand, if you're claiming before your full retirement age, the benefit will be less than 50%. So even though, again, you can draw it at 62, understand you're taking a reduction with that. So higher earning spouse must have claimed their own benefit in order for a spouse to claim a spousal benefit. But again, the spouse only gets that benefit if their working record or their own benefit were less than 50% of a higher earner spouse. So a few things to check up if you are currently drawing Social Security, or if you had a change in situation, you do want to ask or wonder if you fit in these questions. So one, you're a married person who has never added on their spousal benefit. We typically see this in cases where both spouses are drawing their benefit, but one spouse's benefit is less than half. There may be an opportunity to claim a spousal add-on to reach up to 50% of that monthly benefit. Number two, if you're a divorced person who didn't know that you can claim a benefit on your ex-spouse. And I know they say her, but this can really apply to anyone who is a breadwinner or a caregiver or housemaker. Typically they say her because gender roles, typically we found the women to fit that role. But this applies to anyone who is divorced, whose spouse was the breadwinner in that scenario. A divorced person can claim a benefit on your ex-spouse. Again, 50% is that number to keep in mind. If your benefit is less than 50% of your ex-spouse, then there is a chance that you can claim a higher benefit off of their record. Or if you're a divorced person whose ex-spouse is now deceased, making them eligible for a survivor benefit that is higher than their own. I honestly say that this is not just applicable for someone who is divorced and widowed, but somebody that's a survivor and widowed if you were married. There are certain claiming options or strategies that you do want to be aware of between maximizing the total benefits between your own record and then the survivor planning or the survivor claiming option to maximize your earnings from Social Security. So allow us to do that help with you. There's a QR code on the screen. I do provide Social Security calculators and analysis in addition to comprehensive reviews of your retirement income strategy. So I've been talking for a while. I'm a little bit past 30, but I will check the Q&A. Now's the perfect time to submit any questions. Must have done a good job because no questions are coming in just yet. But that will conclude the experience for this afternoon. Again, I thank you for taking time out of this sunny evening, this NCAA March Madness evening to join this experience. Please be expecting an email follow-up and a phone call to take action. And as always, share this information with all of your loved ones and friends. And I hope to see you on the next experience in April. So can't wait to see you then. Have a great evening.